Hi everyone, this is Sandeep Anand. Do you really know why 90% of the funds out there underperform indexes? Or, which is the most common mistake that we all investors do, in our investing life? And the answer to that is selling our stocks or winners too early. In fact, we should be doing the opposite of adding more to the winners and cutting losers from the portfolio. Now, most of us, we have a tendency to reduce the regret, and it's called reducing regret bias in the behavioral economics. And because of that bias, we tend to be happy with a 40% return or a max a doubler from a stock. And after it doubles, we are happy to quit and sell the stock and find another idea. Now, there's a big issue in this. If you really sell after it doubled, there are many stocks. For example, if you had held Netflix over the last 10 years, it has gone up 40 times. Shopify, for example, has gone up 20, 30 times in the last half a decade, depending on the time you entered in. Would you have ever received such kind of 20, 30, 40, 100 times returns if we have an attitude of selling just with a 40% gain or a doubler? Many people think that it is done, it's run up, and I'm out of it. But that's the biggest mistake we all investors make, and that can really hurt our future wealth creating opportunities. The reason being two pronged. First, we seldom get such rare ideas, such rare gems of businesses in our portfolio, which can go up so many times. Second, once you sell out, to find another idea which can give similar returns is really difficult. So those two can really hurt our long-term returns. Now let me come to the point why fund managers underperform indexes most of the time is because of the same reason. The first one, winners becoming a super large part of their portfolio fund size. And there is mandatory regulatory requirements to trim your maximum percentage allocation to a single stock. There is a certain limits in different parts of the world, say like 10% is the maximum you can have an exposure for a fund can an exposure to a stock. Or some managers proactively trim it beyond 10%. They don't allow it to grow because of from a risk management perspective. Now, second point is, reducing the regret bias, as I said, can really cause investors to sell winners early. And example I would say like the recent is the which is most happening fund, which is ARC Investment Fund, Innovation Fund. Their biggest position we all know in the innovation fund is Tesla, almost 10% of your portfolio. But they kept selling Tesla stock this year as a stock went up 6, 7 times. Although their price target is for Tesla is almost $7,000, which is multiple times from the current price Tesla is trading. But they had to sell still in this 2020 just to keep that largest position to 10% of the portfolio. And the reason Kathy Wood, the owner of ARK Investments, told CNBC is that it never lost the number one position in our funds, quote unquote. We had not taken profits in its ride up from $178 to $900 or nearly $1,000. It would have been maybe over 20% of the fund, but that wouldn't be wise portfolio management. We would like to control our position sizes. So this is a mandatory thing that every fund manager does proactively or forcibly. And because of which indexes, whereas on the other side, they keep adding to the winning positions when it's market weighted, market capitalization weighted. So when the winners becoming big and large companies, they get added to the index. That is exactly what we should do, add more to our winners and let them run through their rest of the business life. And for the same reason, index kind of outperform most of the time over long periods of time. The most of the fund managers, 90% of funds. And even we as common investors, we make this mistake quite often, selling our winners too early with the regret reduction bias. Research shows that traders were 2 times more likely to sell a winning position too early and a losing position too late, just to avoid the regret of losing gains or losing the original capital you put. So for retail investors, we are not bound by portfolio management rules or maximum percentage your portfolio a stock can hold in your portfolio. So the ideas are very rare. Such big winners are very rare. And when we find them, it's a good idea to hold or add to your winners. Now, how can we overcome this bias? The simple trick I have started employing is take out the initial percentage of capital that you put in that stock after it doubled or tripled. Say you put 10K and stock has gone to 20K, 30K. You take out the 10K from the put from that stock and let the profits run for through the course for the remaining 10, 15 years for the rest of the business life, as long as it's growing well. So that's one strategy I adopt, and it seems to have worked well. And sometimes I don't even take that capital once I have such high conviction. And if there is such large addressable market, and if there's a new trend that is beginning to climb up. So that's the point I wanted to make, and hope it was helpful. Thanks for staying with me.